Hey, everybody. Thanks for joining. Looking forward to sharing more details about Grand Riviera today.
We are absolutely pumped for this one and the new updates.
Definitely. Okay, cool. So we're still getting used to this webinar style for Zoom, but should be pretty straightforward. I'm sure you guys know the drill, but feel free to put questions, comments in the chat. You can also utilize the Q&A feature. Also, raise your hand if you'd like to ask a question live at the end of the presentation. So at the end of the presentation, we will do live Q&A if you would like to, or just feel free to pepper us with questions during the chat or in the chat during the presentation, and we'll try to address it during the presentation. And if we don't answer during the presentation, we'll certainly get to it at the end. Okay, cool. Okay, so Craig, do you have any other housekeeping before we get started?
Uh, well, I think we're going to get into the meat and potatoes here. I will say we are still looking for a couple more capital partners on this opportunity. So if you are a capital allocator, if you have a 1031 exchange coming up, I think we've got about maybe 10 to 15 days left. If you've got a 1031 exchange tick investor looking to park capital and an opportunity, the minimum for this deal, I believe, is about $750,000 for this opportunity. And then if you are in fact a capital raiser looking to learn more, capital allocator, feel free to reach out to myself. I'll drop my calendar link in here to discuss that, as well as the link to the deal room through our portal, excuse me, as well as the deal room for this opportunity. So a bunch of links coming your way soon.
Yeah. And just to clarify, that $750,000 minimum is for 1031 exchange investors. If you'd like to invest directly into the offering, it's $50,000 minimum, but we'll cover these details in the presentation. So yeah, without further ado, let's go ahead and get started. I'm going to share my screen and share the Grand Riviera presentation that we have here. And then also Craig will put into the chat now, and a bit later on, he'll put the link to our investor portal, which will look like this. When you click on the link, it will take you to our investor portal, specifically to Grand Riviera's landing page. So all you have to do is click on the link to go to Grand Riviera's landing page in our investor portal, and then hit the green invest button. And then this will allow you to fill out some information and hit request access. If you are already an investor with us and you already have a login to our portal, then you can just log in and access the investment directly. But if you don't, then you'll go through that form through the green invest button. So we'll cover that more in the presentation, but that is the link in the chat when you
And
are ready to go.
I just put the link in there. I don't know if everyone can see it or not. Can we get maybe a confirmation if they can or cannot? It just says hosts and panelists. I don't know if that's just you and myself, Rob. If I have access to actually put this out to
Yeah,
everyone.
you need to just change the setting. Instead of to host and panelists, you need to hit to everyone.
It's not giving me that option, unfortunately.
Oh no. That's here I'll fix it right now. Panelists can chat with everyone. Attendees can chat with everyone.
Excellent. Thank you so much.
Okay, cool. All right, and Hunter Johnson has his hand raised, but I do want to get started with the presentation. So, Hunter, please just put your question in the chat if you don't mind, and then we'll be able to chat live after. We're gonna go for the Guinness World Record for quickest presentation ever, while still delivering value. So, here we go. All right, so Grand Riviera. Today we're talking about Grand Riviera, a 206 unit multifamily property in Irving, which is in the DFW market. We'll talk more about the Irving submarket and what we like so much about it. But before we do, I just want to give a quick, brief overview on us at Lone Star Capital. So me, myself, if you guys aren't familiar, I'm one of the founders of the firm, Rob Beardsley. Ken Petrokovsky is my business partner. We started the company back in 2018. We've since acquired over 600 million in multifamily properties throughout Texas, and we have also built a vertically integrated property and construction management platform that's based in Houston. Here, I'm just going to breeze through the front matter, but if you're not familiar with us, feel free to review this deck on your own time. And also, if you'd like to discuss further, you can schedule a call with Craig and we can share more about the company as well. One thing I'll highlight for people that are not new to the firm is you'll see that we've recently added Daniel Cohen to the team. He's coming to us from Related, which is one of the world's best real estate companies, and he's been a great addition on as a controller on the accounting side to really help clean things up and make things much more institutionalized and streamlined on the accounting side of things. I'm going to skip all this, but feel free to review this on your own, like I said. So let's dive into Grand Riviera itself. So as I mentioned, it's a 206 unit deal built in 1972. That's something that we're going to harp on a bit because a lot of people are scared off when they see that 1972 vintage. But through our business plan and through the actual bones of the deal, we've gotten comfortable with buying an older asset. So we'll share the details on that shortly here. But you can see we're purchasing the property for a bit over $145,000 per unit, and we have a renovation budget of nearly $20,000 per unit, or just over $4 million. So big renovation budget. We're going to come in there and really transform the property inside and out, which is going to allow us to command over $155 rent premium, which I think is very achievable when you study the comps. We first saw this deal back in January, and we participated in the bidding process for this deal. The seller had to take this property to market and sell it because it is owned in a fund vehicle, and this was the last property in the fund, so they needed to sell this property to close out the fund. Seller bought the deal in 2018, so they're still making a profit on this sale, but they didn't really invest much into the asset over that time. So what we're buying here is a true value add opportunity where the seller hasn't recently renovated the property, providing us the opportunity to take this deal to the next level and really match where its competitors have gone. A lot of the properties in the nearby area have already seen renovations, specifically in the interiors. So this property is now lagging the market. So we're not necessarily buying a property and trying to make it the top. We're just bringing it in line with the competitive set.
Yeah, we're not trying to reset the market with the rents we're looking to achieve on the exit price or anything of that nature. We're just basically bringing it up to snuff. And I really think that, through this market cycle, I think everyone wants to do value add deals, us included, but very few deals are actually ripe for the opportunity where we're going to get paid on our efforts. And we found this one to be perfect for just that.
Yeah, so we'll go more in depth into the business plan, but not just on the interiors, but on the exteriors as well. We plan to repaint the exterior of the property, address deferred maintenance on the roofs and the foundation, as well as enhance the amenity set. So that's a robust business plan that we're confident is going to create a ton of value at the property. Location-wise, as we mentioned, the property is in Irving, which is a great pocket of DFW. First of all, DFW, as many of you know, is perhaps the best market in the country for population growth and job growth. Such a strong multifamily market, and we think that that will certainly continue to be the case. But specifically, what we like so much about Irving, where this property is situated, is we're right in between DFW International Airport, which is the fourth busiest airport in the world. So we're just as close as you could be to the airport without actually hearing the planes. And then to the east, you've got Las Colinas, which is nicknamed the headquarters of headquarters. You have over 2,000 corporate offices and over 30 Fortune 500 companies call Las Colinas home. So this is kind of one of the epicenters when people talk about DFW's job story. There's so much going on here and so much growth. Going back to DFW, American Airlines recently announced a plan to build a $3 billion terminal and also upgrade its headquarters there. So there's jobs to the west, jobs to the east, and what we really like about Irving is it's kind of the affordable workforce pocket that's in between the two. Because if we were over in Las Colinas, there's a lot of development. It's Class A. There's concessions. There's oversupply. But in our pocket here in Irving, we've got older properties that we're competing against, and there's no new supply under construction within a 2-mile radius.
And also at large, this property really isn't directly competing with what new supply would be. This is more true workforce housing.
Yes, very true. So let's dive in to some of the numbers here driving this business plan. So we're acquiring the property at a 5.44% cap rate. And through our business plan, we're projecting to stabilize to a 7.14% yield on cost. And that's very competitive, in my opinion, in the Dallas market. Dallas is a hyper competitive market, right? Because it's no secret about all the growth. So it attracts a lot of investor capital, a lot of competition. So it is definitely difficult to you can fall in love with the story and the kind of growth behind a deal, but it's hard to fall in love with the numbers oftentimes because deals get bid up too far. And so I think this deal is that perfect balance where you've got the growth, you're in Dallas, but the numbers still make sense. Going in at a mid five cap's very healthy. We're projecting to exit at a 5.5 cap, which I think is very justified in Dallas. You know, today we're already seeing cap rates compress back in Dallas into the fours. So that's just the kind of market Dallas is. On the debt side, we have a pretty creative and innovative debt structure that we're working with. So we're partnering with Greystone, who's a many times repeat debt partner with us. We've closed right over $200 million of loans with Greystone now. And we've come up with a great strategy to, instead of a bridge loan, which I know many of you who've studied this deal before this very moment, we've shared information about doing a bridge loan on this deal with Merchants Bank. Well, uh, literally as of yesterday, this is hot off the press. We just updated all the numbers and everything, but we're pivoting to do a Freddie Mac 5-year fixed rate loan with Greystone. And then Greystone's going to provide a very attractive preferred equity piece on top of the senior loan to a total loan amount of about 24 million, which is exactly the loan amount that we were contemplating on the bridge loan. So some people are familiar with preferred equity, some people aren't. Some people hear it as a something to be afraid of. I mean, like anything that's related to debt, debt cuts both ways. So yes, it's something to be cognizant of, but in this case, we're not adding more leverage on the deal than we already anticipated in doing so. We're financing the deal at 71% loan to cost. And given the value that is going to be created through this very heavy hands-on business plan of nearly 20,000 per unit of CapEx spend, I think 71% leverage is appropriate. The other beautiful thing about this financing structure over a bridge loan is we have a 5-year term. And the 3-year term of a bridge loan is typically uh, gets people nervous because 3 years can be seen as a tight window, and the market may not be where you need it to be in a 3-month period of time to exit that loan successfully. So with 5 years, those 2 extra years really provides more runway, more cushion, and flexibility to hold on to the loan if we need to. Yet, while importantly, we've structured the loan flexibly so that we can still sell or refi in 24 to 36 months with a limited to no prepayment penalty. So, Craig, I know you're super excited about this change in structure. Do you want to just kind of give a quick recap there?
Yeah, I mean, essentially, when Rob called me saying the news is great, my investor relations hat went on, and I was like, okay, well, great. Now I have to re-explain this deal once more. But as we kind of broke down the opportunity, basically the deal is now safer as we have a longer tarmac on it. The in returns got enhanced, and the economics are better. So really, any way you slice it, it's just a cleaner and more simplistic opportunity. Not to mention our debt is also cheaper too.
Yeah, exactly. Being able to reduce our risk while reducing our cost of capital results in higher returns and lower risk. So we think this is a great way to go, and the numbers speak for themselves on that front. So very excited about this update. Feel free to ask more specific questions about this as well. Uh, to go through the value add plan a bit more, we talked about interior renovations. There are 55 units currently considered partial unit upgrades, but really they're just barely over classic. You know, these units are so dated that all the units are essentially in classic condition with resurfaced counters, white or black appliances, and original cabinetry. So we're going to be going in there with new paint, new countertops, uh, stainless steel appliances, new flooring, the whole works. It's going to be completely transformed, and that's going to allow us to upgrade the rents and push revenue. On the other income side of things, we're going in with a bulk Wi-Fi package, which we love, and we see that as a huge value creation, and we've been rolling it out across our entire portfolio. It's a great way to generate other income for the property. It's a win-win for tenants as well because we can often provide them Wi-Fi for cheaper than what they're currently paying for from a third-party provider. Another thing we're implementing is a tech package, which means we're installing smart home tech package for the door locks as well as for the thermostats. And across our portfolio, we're able to generate a $19 per unit per month net income benefit there. We'll also be installing 50 carports, which we are projecting to generate $45 per month in revenue. And then also for there's about 60 units or more. We're being a bit conservative with this projection, but there's about 60 units which will be installing full-size washer and dryer machines and capturing a $50 per month premium. And we all know that installing washers and dryers is always a very good, very high ROI value add program.
Especially for properties like this as well. This unit mix we'll get into later. It's mostly twos and threes, and this is certainly a family oriented property. So that will be a big value for the families who are on site here.
So on the exterior side of things, we touched on repainting the property. So that's going to really help with the aesthetics on the outside, help with curb appeal. We're going to be refreshing the amenities. There's currently a dog park. There's 2 pools. They need some renovations. They need some improvement. The playground's very tired. So everything's just dated. We need to get everything up to par and really breathe a lot of life into this deal, which our budget is more than aptly prepared for that. And I'll just reiterate one more time, the business plan, we underwrote this deal actually on a 3-year hold. So we are planning to execute a sale or a refi in about 24 to 36 months, obviously depending on market conditions and the success of the business plan. But we think that a near-term sale will be the most attractive exit for this property. Okay, so on the returns, if you've invested with us before, you're going to be very familiar with this structure. Our typical deal structure, we have a 50K minimum investment, and that is for Class A investors. And the different classes just basically provide a difference in waterfall. There's no difference in priority of distribution. So for 50K minimum, there's an 8% cumulative and compounding preferred return subject to return of capital. And then thereafter, there's a 70-30 split up to a 15% IRR. After the 15% IRR, remaining distributions are split 50-50. And then for the Class B investors, which is a 500K minimum, the preferred return is bumped up to 9%. And then there's a 70-30 split thereafter. So simpler, more accretive waterfall for the Class B investors. If you're interested in learning more, just please reach out to us. And you can see in the bottom right here, the projections over a 3-year hold. It's about a 1.64x equity multiple. And you can see the average cash on cash year over year and averages to about 6%. So these interior pictures give you a sense of kind of the nicest, what the nicest units look like. That's they don't even have a model unit, which is another sign of the value opportunity here. It's standard and best practice for properties of this size to have a model unit that is essentially a unit that is furnished and looks really nice so that when prospective tenants come and tour, they're shown the model unit, and so they get a real feel for the property, and then they perhaps are shown the particular unit that they're interested in if available. But you can see in this case, it's black appliances, but the majority of units on site have white appliances. You can see the resurfaced countertops, old flooring. This one actually has some upgrades via the cabinet fronts, hardware, lighting, and the backsplash in the kitchen. So all that will be upgraded and renovated even on the partial units.
And I also say the clubhouse too for the property having some deferred maintenance actually is pretty presentable. So it is a nice first look into the property.
On the exterior side of things, we kind of talked about the 1972 vintage of the property being a downside, but you can see just from the exterior, I would argue this looks more or less like an 80s vintage deal. You've got pitched roofs, you have individual HVACs, PVC plumbing, copper wiring. Unfortunately, 8-foot ceilings, but you don't really see 9-foot ceilings until you get into typically 90s construction or newer. But all in all, really good bones for a 70s vintage deal. And given the CapEx work that we're going to be spending to uh, renovate on the or fix the foundations and the roofs, we're going to have a very stable asset where we don't think future deferred maintenance is going to pop up outside of our budget. Also, if you notice, the parking is over a 2x ratio, so that's really great to see. Plenty of parking available at this property. And then we'll quickly cover the amenities. And then I really want to get into the unit mix. I feel like we're bearing the lead a little bit about these oversized units and these twos and threes, which we'll talk about here in a second. But here you can get some more sense of the pictures. You've got in the middle left picture, you can see the fitness room. Fitness room is in the clubhouse right off the leasing center. It's actually pretty nice for a property of this caliber, so no major complaints there, but definitely the sport court in the far right picture. We need to completely renovate that and breathe a lot of life into that, as well as this main pool picture that you see here as well. Okay, Craig, why don't you share about the unit mix?
Yeah, well, so as I kind of alluded to and mentioned earlier, this property really is perfect for families. It's a lot of kids in the site. It's 70% twos and threes. And I think, Rob, you actually made a really interesting comment pertaining to just specifically how, one bedrooms are kind of affected from a rent perspective a little bit differently than twos and threes. So it'd be nice for you to get into that. But before you do so, Brad Oliver, our director of acquisitions, who does, of course, all the underwriting, and really has the best pulse of the market, was on this at this property during spring break in March when we were doing our mixer in Houston. He went there after, and he kind of saw some glaring issues just with the property itself. It just really isn't up to snuff. There's a lot of kids here at this property, a lot of families, and the amenity set is just really lackluster. So the twos and threes really cater to families, which this property is. So by fixing kind of some of the deferred maintenance items, bringing it up to par, we will really get a great benefit there. And if you want to kind of mention maybe that rent gap there, Rob, pertaining to multiple bedroom units having a different kind of different, I guess, angle to rent dropping or rent stagnation would be cool to break down.
Yeah, we've just seen this across our some instances in our portfolio and on deals that we've been underwriting as well. Is just one bedrooms are struggling more so than twos and threes, and I think that's just a sign of the times right now where we are in the market. But even in a normal circumstance, you always prefer, generally speaking, twos and threes because they're more family oriented tenants who generally stay longer and result in lower turnover. So in this case, we have over 70% of the units are 2 bedroom and 3 bedroom units. And the other piece about it too is the 1,100 square foot average unit size on the property. So we have the largest units in the submarket, so that's a differentiating factor, makes this a very attractive, affordable option for families in the area. We'll look at the rent comps here shortly, and actually take a look. We can get over there shortly, but yeah, the rent comps, we have larger units, and then we're projecting to push rents only to be in line with the smaller unit comparables.
Yeah, and that's kind of what I was saying earlier, how we're not really trying to reset the market here with new rents. We're just basically looking to bring it to par. We do think there's probably a chance that we can actually outbeat the best rental comp, which is also a 70s vintage asset. So we think we can achieve that and possibly beat it, but we're underwriting to be conservative just to stay at par with them.
Yeah, yeah, and this is a good discussion. A couple people in the chat have been asking about, workforce housing. Isn't the idea to keep rents low? Uh, Not exactly. Obviously, landlords have an incentive to generate a profit, but in this case, our rents are below market, and so there's no advantage to necessarily having your rents below market, but bringing them up to market makes a lot of sense as long as we're investing into the property and providing a quality product to residents. So we're not trying to be the most expensive rents in town or push the envelope here. It's just really bringing up the property up to speed because right now it's lagging its competitors. And then another question came in about washer and dryer connections. So we don't actually plan on installing any washer and dryer connections. there are existing connections in place. And Sam's asking what class is this property? This is a C class property. So as you can see in the map here, Grand Riviera is right next to DFW. This gray blob here is DFW Airport, which services the DFW Metroplex.
Which is
Which
somehow growing too, by the way, the airport. American Airlines is adding another terminal there. So that just will only add to more of the workforce nature, jobs for the area to service there. And it's no secret that Dallas is truly one of the economic hubs of the country, one of the best and safest markets with just, enough influx people coming there to support the demand and also push up the rents. Hence why it's such a competitive market. It's not a secret.
So and then to the east is Las Colinas here. And Craig and I were in Dallas last week and we were on site at Grand Riviera. And then the back half of the week, I was invited to Newmark's national client housing event, and they hosted it at the Ritz-Carlton in Las Colinas right here. So this is, true five-star golf, country club, spa, dining. This is like a very class AA hotspot. So you can see we're not in that true mix, but we're right very close by. So the Ritz for me to Grand Riviera was about a 15-minute drive. So I really love this pocket here between DFW and Las Colinas. On the submarket, and we talked about Irving, just its proximity to DFW and Las Colinas. In Irving, we've seen rent increases of about 2% in the last 12 months, and Yardi projects rent growth to be at about 3% plus through our hold period over the next 3 years, which is a total of about $200 in organic rent growth through the next 3 years. So I feel like we've covered this already, but definitely there's just so much to talk about when it comes to the convenience of Irving being kind of close to, you can certainly get to Dallas, no problem. You've got Las Colinas, tons of jobs there. And obviously all of that, all those headquarters and high-end corporate jobs trickle through to more service and retail-oriented jobs in the vicinity as well. And also it's convenient to get over to all the jobs at the DFW airport. Okay, so what we wanted to show you here on the rent comps is, when we were there last week, we've really pinned Maxton West as our goal rent comp. It's just down the street. It's actually not on Walnut Hill Lane, and so we actually have frontage on Walnut Hill, which is really nice. And as you drive up Las Brisas, this is a very nice single family pocket.
Oh yeah.
Craig and I enjoyed driving up Las Brisas, so this is a nice entryway to Grand Riviera right here. And then Walnut Hill obviously provides a lot of frontage and street traffic. So Maxton West, location is basically the same, but it's not on the main road. So maybe that's, I'd say it's all being pretty equal here. But you can see that Maxton West has units that are on average 200 square feet smaller, and yet the um, rents are basically at where we are projecting to take them. So I don't know how to say it any simpler, right? We're projecting to hit Maxton West rents while we're going to be 200 square feet larger, which I think is a very
And
compelling argument.
yeah, we'll have the newest units. And, as Rob and I drove around and actually walked that property, we didn't feel there's anything that they were achieving or accomplished that we can't do ourselves. And then also the bonus is we've got 200 larger square feet units, which would make us more competitive in the marketplace. And then just to go back to that front and note pertaining to the local area, I think we've all been in areas where maybe wouldn't feel comfortable walking around at day, night, so on and so forth. I think Rob and I would feel very comfortable to walk around, smoke a cigar at night, as we typically do, and have no, second thoughts about doing so, as we aren't in a bad neighborhood or area.
Yeah, crime is not an issue here, which is great. On the sales comp side, you can see that there's not a ton of transaction activity right now, which is kind of nice because it's creates opportunity, but there's just less sales comps to be had. But these are relatively recent sales comps towards in the middle and end of 2023. Certainly, all of these sales comps are after the dramatic, I call it the interest rate regime change. So
Right.
we're not pointing to any peak sales back in 2021 and 2022, which were at much higher bases. So in this case, our acquisition price of 145,500 per unit is very compelling, competitive, considering that deals were trading much higher and compared to what you're able to acquire today. If you look at, given our unit size is so large, you can see that our $131 per square foot is way below the average of these sales comps. So our price per unit is kind of looks a little bit more than it is because of our large units. But then when you look at price per square foot, that's a really compelling picture as well. Okay, that pretty much wraps it up with our presentation. We'll quickly take you through next steps and then also answer some more questions, which we're seeing a bunch of good questions today. So really appreciate it. But just to catch you up to speed, we signed the contract back in early March. We've done our due diligence. We've been on site multiple times. We're live to investors as of Monday, and we're at about uh, we're about 60% committed at this point. So we definitely urge you to take another look at this investment. If you're ready to commit, please commit soon so that way you can get your space held and then meet the funding deadline of June 14. And we're currently on track for a July 5 closing. I know it's going to be a tough time with the 4th, but we're going to make it work. Okay, so let's go here into let's go into the questions here. So Elsa asked about what does the tech package include? So the tech package includes a smart lock and a smart thermostat. Mahmood asks about supply. So he says, when there's more supply than relative demand in today's market, assuming it's true and you agree, how true are your rent bumps for the next 3 to 4 years? I think that's a very thoughtful question. And I think that over the next probably year and a half, I think that rent growth is going to be softer. But then, given that there's very little development in the pipeline, there's going to be, in my opinion, a rebound in rent growth due to a strengthening economy as well as a dearth of new supply. So I think certainly it's not going to be linear where you get steady rent bumps every year. I think it's going to be kind of softer or flat for the next year or so, and then it's going to ramp up. At the end of the day, the reason why people fight over each other to invest in DFW is because of the rent growth and because of the stability. So if the country does have a recession, Dallas will be the last in and first out of the recession. So that provides me comfort as far as our rent bumps. And then Sam, and for other people who aren't familiar with our company, Lone Star Capital, we are a vertically integrated owner operator. So we have property management and construction management in-house. We have a full corporate team down in Houston, and we're currently in the process of hiring a dedicated regional manager to oversee the 2 assets, once we close Grand Riviera, the 2 assets that we own in Dallas. And
This
if
deal's
you're
a 506C, by the way, which means it's for accredited investors only. So that answers that question there. And then we will be managing this property in-house with Lone Star Capital as we do all of our deals. We do not do any third-party assignments. We'll build out our blueprint further here. So that should answer that question.
Yeah, so if you'd like to
And we
get
also do construction management in-house too. Sorry.
yeah, if you'd like to get more if you'd like to get more details on this deal, go over to the portal here. You can submit your interest, and then once you are approved into our portal, we have all of our documents here, so you can get access to the underwriting model. You can get access to the pitch deck that we went over today, and the seller's financials and more due diligence. So please jump in there and do that. And if you have further questions based on that material, we'd love to answer those.
Yeah, and then it's just once more, if everyone wants to look to the link right now for some kind of high level questions, as Rob just alluded to, link to portal to go to Appfolio where you can see a lot of this information. You can request request a space in this opportunity to invest while there is still space. There's linked to my calendar if you'd want to review this deal and kind of our theory and logic into this opportunity further. And then also finally, deal room, which has our underwriting and deck and whatnot. It's all there. And just so everyone kind of is just aware of what's going on and how much we love this deal. So I was still planning on obviously investing in this deal like I did before, I roll all my acquisition bonuses into this opportunity. Due to the change in the debt structure, I just texted Rob and Dasha this morning, and I think even yesterday. But I'm jazzed up about actually increasing my investment and actually, putting some more capital into this deal, just due to I feel how strong this opportunity is. It's just a really big win to have that updated debt profile, which should really juice up the numbers, increase safety and certainty. And I think it really just eliminates, about half the risk and the opportunity. While also the craziest thing too is the lender spread we got in it. I don't think we really covered that, but we got a really phenomenal lender spread. And then also we maintain our autonomy to sell at year 3 without having any exit penalty. I mean, that's huge. The debt structure we got in this deal is really special. Maybe Rob, you want to go into as to how we got that kind of opportunity and why it came up kind of, I guess, a little bit later, perhaps.
Well, yeah, I mean the debt markets have been very volatile, which has been it's been a difficult environment to transact because you never know what interest rates are going to be the next day. And so as interest rates have dramatically been going up and down, we originally went to a bridge loan on this opportunity because it's the floating rate loans don't change as much as bridge loans, or floating rate loans don't change on a daily basis like the way that fixed rate loans do. So you can kind of have a more stable view into what your interest expenses are going to be. So it's tough to make fixed rate deals work. And with the recent rise, it just kind of made no sense to do fixed rate. But now rates have come down a little bit. The inflation reading yesterday was quite positive and unexpected. The street didn't anticipate inflation to moderate like that. And then the previous, I believe it was a week and a half ago, the labor report came out a week as well. So I think the signs are there for slowing inflation, which is helping alleviate interest rate pressures. And that's making us now comfortable where the numbers make sense to pivot to the debt structure that we mentioned, where we're using a fixed rate 5-year Freddie Mac loan and then the preferred equity on top to kind of generate a bridge loan like deal where we have the 70% loan to cost of the bridge loan, keep the flexibility, but also reduce our cost of capital. Evan's asking, what is the cash flow for year 1? I
I
believe
believe
it
it's in about
is,
5%.
I think it's 4.9. Yeah, so it's 4.9% projected year 1. We project to close this deal in July. And so that means we'll probably make the first distribution work at the end of August.
Yeah, so I'd expect just by September you'll have capital coming in from the deal.
Monthly distributions, monthly updates, quarterly reporting.
Yeah, so the sub-market rents, I think we went into that earlier. I don't know if you're on this or not, Brandon, but we are below what some of the comps should be. The best comp is Max and West, which we're about $150 short. Where right now, once we renovate and improve the units, we should be at par. We do believe we could do better considering all the latest and greatest, but that should answer your question there.
Yeah, Brandon, it's a pretty compelling story in the rent comps, in my opinion. We are the largest units in the submarket, and you can see Maxton West has had it's an older property like ours, 74 vintage, and they've had a renovation. Our renovation will be as nice or better, and we have frontage to on Walnut Hill, and we're closer to this Las Brisas single family neighborhood. So I would say I mean, this is just literally 2-minute walk, but I would say we have a better location, slightly bigger units, and we're comping our pro forma rents to be in line with Maxton West.
Although we will have the latest and greatest and 200, that's right, 200 more square feet. That's a lot, especially if someone lives in New York. Rob can tell you all about extra 200 square feet. That's, obviously in Texas, it goes for a little bit less of a price,
I'm
but nonetheless, 200 square feet is not a nominal feature.
Yeah, I'm walking into the unit with my tape measure for sure.
Yes.
Mehmood's asking how much are GPs investing in this deal? Approximately 5% of the equity is coming from GPs and family of the GPs. And then you also ask, yes, your 8% return guaranteed or not based on the current market conditions and forecasts.
We don't
So
use the G word. So
yeah,
first
the
off,
G word
G
is, I
word does not exist.
shouldn't have even said it.
Yeah.
I can't believe
Yeah.
it came out of my mouth.
Yes, that's a curse word.
But yeah, so a preferred return doesn't mean it's a guarantee of distributions or anything like that. So some investors get confused by preferred returns and cash on cash returns. So the preferred return is a mechanism to provide a minimum level of return to investors before the GPs can participate in any profit share. So what's going to happen is we project 6% cash flow throughout the life of the deal, but all the while investors will be accruing a cumulative and compounding 8% or 9% preferred return. And so when we sell the property for a profit, that 8 or 9% preferred return will be caught up because the distributions have not been up to that point. And then um, from there, once that minimum preferred return is met, then the profit share and the waterfall kicks in. Hopefully that makes sense.
Also, we had a question here talking about just the renovation timeline. So we plan on stabilizing the property within 24 months. And it's funny, we have about 90% occupancy on the opportunity right now. So if you do some math, it's about 20 units that are open based on there. And that occupancy is certainly due to, in our opinion, the lack of just general deferred maintenance on the property. So I think that's very much so something we can do, but it's also nice where it is currently for us to kind of kick that up and to improve the property. So, but to answer your question in short, 24-month stabilization period.
Yeah,
We're
we've
actually getting
done.
a lot of great questions right now too, by the way.
Yeah,
So let's just keep it flowing.
yeah, we've done projects of this size in 24 months or less. I think 24 months is very doable. And like Craig said, if the property is currently at about 90% occupancy, and we don't want to create more than normal vacancy to do our business plan. So, uh, but we are projecting to take over at 90 and then over 24 months, slowly lease up to 95%. Um, which is very doable in a 24-month period of time because
And we have done this
today,
before too.
yeah, well, today, just to do the math, right? If you have 10% vacancy on 200 units, that's 20 units that are vacant at any given time. So you can do your renovations. Like Jeff is asking, how do you intend to stagger your renovations? Basically you do renovations upon natural turnover. So when a unit lease is up, you if the unit turns over, then you have the opportunity to renovate the unit and then release it. And we can renovate a unit in a week or two. So we can produce many renovated units per month, and we don't have to generate artificial vacancy in order to do so.
The exit cap rate, sorry, this is a little bit out of order. Exit cap rate projecting 5.5%. And that's in our model too.
Scott's asking, is this property profitable today at current rents and occupancy? Yes. Yes. And the stabilized break-even occupancy when factoring in the senior loan and the preferred equity current pay is 74% occupancy.
And that's a great question. And that's something we obviously factor into our model. If you go to the sensitivities, I believe that's the section it's on, you can kind of see break even, where that looks like. That's a really smart question to ask, and something I always consider as well when looking into these investments.
Kenneth is saying, what should our concerns be about pauses and distributions that we've seen from other projects as we make plans around the cash flow? I think that's a great question, and it's
Mm.
it's a pretty comprehensive question because you have to step back and ask, well, why are distributions being paused on many projects today? We're fortunate to, out of our 17 property portfolio, we only have 3 deals that have floating rate loans and that are paused distributions. So therein lies kind of the challenge in many projects today is floating rate loans. A lot of deals were made in 2021 and 2022, early 22, when short rates or SOFR, for example, was near zero. And now SOFR today sits at 5.3%, which is the highest rate in 23 years. So we've seen a dramatic, unprecedented, unexpected rise in interest rates. And that's, like I said, fortunately, most of our deals, the vast majority of our portfolio is fixed rate. So we don't have this problem everywhere. But it's very hard for many properties today to pay distributions when they've seen their interest expenses rise so much. So to answer the question about those concerns on this deal, they're not the same because this is a fixed rate strategy. So whenever you can have a fixed rate loan in place, it really eliminates one of the major variables of investing in real estate. So I think hopefully, Kenneth, that answers your question. And then Jeff is asking, is it on a bus route? I actually don't know the answer to that. So we can dig that up and get back to you. But I believe it is actually. And then yeah, you already answered the exit cap rate is 5.5%. And then David Robbins asked, any concerns getting contractors lined up to do the reno work on the schedules you're talking about? No, actually, we do a lot of the work in-house, and we certainly feel like we're not going to be pushing capacity in order to make this business plan go. Okay, more questions coming in. Um, okay, so Mehmood asks, what if you can't sell after 3 years and occupancy declines? What strategies will you apply to stabilize based on your past experiences? Not to mention the current market is completely different than what we had in our recent past. So
Yeah, we agree.
if we can't sell in 3 years, the good thing is we'll have 2 more years of term remaining on our debt, so we'll be able to ride out that period of time. And I think time, whenever you have challenges in a deal, you need two things: you need time and you need money. So having the 5 year term on the debt is really valuable for the time aspect. From a money aspect, our blended current pay requirement is 6.2%. So we're buying the property at 5.44% cap rate. And once we push revenue just part of the way, we'll be at neutral to positive leverage. And actually, just for fun, I'll pull up the underwriting model so we can take a look and see exactly when that is projected to take place. So if we look at the pro forma, we go in at the 5.44 cap, and then over the first year, we're projecting to raise revenue by 7%. And that's coming through headline rent increases as well as pushing other income and burning down vacancy a bit. So I think given how much we're investing into the property, I think 7% in the first year is a very reasonable assumption. And then we're projecting to increase expenses quite a bit here. So in the end, actually, we are projecting in year one from the seller's current NOI, we're projecting a 1% decrease. So I think that's a pretty conservative estimate there. And that results in a 5.51 cap for the first year. And then you can see the magic really happens into year two as we stabilize and we push revenue further and really see those gains come to fruition. And so at the end of or throughout year two, on average, our cap rate will be 6.8%. At least that's what it's projected to be. And so that pushes us into positive leverage territory given our current debt payment of 6.2%. So that's a really good thing, because if we don't see the performance that we want and we don't get the occupancy that we want, like you mentioned in the question, we have a good cushion where we can see that decline and we have a good buffer to be able to still survive, right? Because you're talking about in a downside scenario, it's all about survival. So you want to be able to live to fight another day and have that time to get to the other side. So that's the benefit of the 5 year term on the debt structure, and then having a nice cushion and a 74% break even occupancy in year two. Okay. Uh, Elsa says, what is the minimum amount to invest as a GP? Um, there is no, well, the minimum is typically $1 million to partner with us as a GP. So if you'd like to learn more about that, just please reach out to Craig directly and we can share more info offline.
I will, for the 1,000th time, link my calendar, and I'd love to do it. I'm also seeing a lot of appointments trickle in. I do greatly appreciate that. So I love talking to all of y'all. I'm addicted to talking on the phone and Zooming, as Rob knows oh too well. So please fill my calendar up so I'm not pestering Rob.
So a couple questions actually both at the same time coming in about depreciation. So yes, every deal that we do, we perform a cost segregation study and elect bonus depreciation. Bonus depreciation for 2024, as it stands today, is 60% bonus depreciation. So obviously that's not as lucrative as 100% bonus depreciation of a couple years ago, but it's still pretty attractive. I think given the that factor and the terms of the deal, we're projecting around, I think, 35% of uh, one's investment in year one depreciation. So if you invest 100K, you can expect to see $35,000 of depreciation on your K1. And I think that's a conservative estimate.
Also, we had a question pertaining to the bus line. The Brad just got back to me. He said it's a 3-minute walk to the bus line, which is great, perfect for workforce people. And then also we had a question if we've ever made a capital call. The answer is we have not made a capital call, nor do we plan to do so.
Okay, awesome. Well, thanks everyone for the engaging questions. It looks like we're wrapping up here, but if you have further questions, please reach out to us. You can firstly go to the portal link and submit your interest in getting access to the deal. And then if you'd also like to speak and get in touch, Craig is, like he said, has put his calendar in the chat. So grab a time on his calendar. We'd love to speak with you. And we look forward very much to partnering with you guys on this deal and in the future. Thanks.
Access to slides are in the portal, by the way. I will leave that one more time. Or sorry, not portal, excuse me, the deal room. I will
No, you
send over
can,
the
they're
deal
in the
room.
portal. So
Oh,
better to
portal.
link to the
Perfect.
portal and then they can submit the
Sure.
access and get in there.
Yeah, perfect. Even better. Why add an extra step? I love it.
Oh, I can't help myself. There's more good questions.
I know.
All right. So Hemant is asking about uh, our bandwidth perspective and our ability to grow. So, we currently we've built a good foundation of regional managers and vice presidents on the ground overseeing the portfolio. So scaling is a very linear activity. We just need to continue to hire more regional managers and vice presidents. And we're currently in the process of hiring another asset manager here in the New York office. So we're gonna, we understand the importance of property management, and we are heavily investing into the management side of the business. We made a commitment that we're not going to have more than 10 properties per asset manager here in New York. So we need to make sure that we have full attention on every deal and that we have the right people in the right seats, both here in New York and in Texas, to be able to manage the whole part of from the business, from the acquisition, transaction, to the business plan, to the management, to asset management, reporting, investor communications, taxes, K1s. So all that is really important, and we're investing heavily into the growth of the business. So that our growth is not overwhelming, because we do plan on continuing to acquire about 6 properties per year. And so we are continuing to hire in anticipation of that.
Yeah, no, it's super important, as an investor in these deals as well, how these deals are managed and whatnot is crucial. It's the stake, everyone, you can have really nice, attractive marketing materials and whatnot, but how the deal is managed and, taken care of during the investment process is separate to that. So we want to make sure that that's just as on point as a Rob Beardsley webinar underwriting tutorial.
Okay, and then last question, I promise, because Mahmoud keeps asking awesome questions. So, what percent of your target have you reached so far? I believe we're 60%. I think that was as of this morning. So, uh, yep, that's where we are. If you would like to get in touch, you know what to do. Thanks everyone for being here, and we'll see you guys next time. Thanks.
Thank you.